Before we begin, a quick disclaimer. The show is for entertainment and informational purposes only. Nothing said on the show is investment advice or a solicitation to buy or sell any security. Nothing said should be relied upon as investment advice. Both guests, the host, and clients of either may own any securities mentioned. Without further ado, let's go right to this episode's special guest, Rico. And this is from the House of the Special Situations Report. Today we have a very special guest. It's Harris Kupperman from Praetorian Capital and the well-known site Inflection Capitalism. Recently launched KDM. Harris, you told me it's okay if I call you Kuppy, so I'll do that from now on. Welcome to the show.
Hey, thanks for having me on. Appreciate it.
No, it's entirely my pleasure. So for people who haven't seen you because you're like a regular on some great shows like Real Vision, you've appeared several times there, I think. And
yeah,
on the market,
I've been on there a few times. Actually, a great show.
It is, and I think it's very widely watched, so maybe everybody knows you. And the Market Huddle, I think it's widely viewed or listened to. That's a great show. You're a regular there, right? Or like once a month, or?
Yeah, basically once a month or whenever a guest cancels.
Okay, that's. I love that show, and it's always really entertaining if you when you get on. But could you, people who don't know you, maybe you could tell us a little bit about yourself. I think you're a history major. That's a little bit of an unusual background. And how did you get into investing, and why do you love it so much?
So yeah, I am a history major, and I look at the world, I think, very differently than most people that look at the world through spreadsheets because they're business majors. As a history major, I know that these cycles repeat over and over and over, and no one ever learns from their history. And if you are willing to look at the past 10 or 20 cycles of whatever the thing is that you're focused on, there'll be interesting data there, and the stuff usually repeats. So I just think that's where the edge is. I got into stocks. I got really hooked when I was in boarding school. Instead of going to class, I had a few $1,000s from cleaning pools one summer, and I was day trading stocks poorly. And I eventually figured out how to make money at this. And my senior year of college, I launched a hedge fund. It's been very successful. That's my track record. That's my history. I've done basically three things and done them well throughout my career. One is small cap growth. That's really the thing I'm most excited about. Unfortunately, we're in this weird moment in time where anything with any revenue growth trades at stupid multiples. And so I think we'll talk about a few of them today that are really cheap, but for the most part, I'm not finding much to do there. I remember 15, 20 years ago, you buy small cap companies growing 50% a year, and you buy them at 5 times after-tax cash flow. Now you can't buy them at 5 times revenue. So we're doing a lot more inflection investing, which is cyclical businesses that, you ride the cycles. It's secular changes in businesses, but then we're doing also a lot of event-driven, and often they overlap. When you change your cap structure of a company, whether it's a spin-off or a recap or anything, buybacks, anything like that would change the cap structure, to change the valuation. Changing the management, CEO change, spin-offs and demutualizations and privatizations, and bankruptcy and post-bankruptcy, all these strategies that are really the bedrock of event-driven trading often coalesce and overlap with these inflections too. I mean, companies go bankrupt because their sector goes crappy. Usually you'll see a lot of companies come out at the same time. That usually is what sets up the next upcycle in that industry. Right now we're seeing energy and energy services all emerging from bankruptcy and going straight up. So, you can overlay these two. I want to talk more about the event-driven side, but I don't think it's right to ever look at one discipline in isolation. And when they overlap, there's usually better signal to noise. And That's really my background, is those three strategies and doing the same thing and hopefully doing it better each time.
You know, that's like super interesting. So you've been in like small cap growth, like after the financial crisis, when it's like one of the better areas to go into. That's when you wrote that, or was that like straight away an interest from back into college?
Oh, just straight out of college, I was playing small cap. I mean, I started doing. I started a lot of day trading because I mean that's what I saw people talking about. But when you had a dial-up modem and the market makers don't display your bids and offers, and you have classes to go to, you can't be much of a day trader. And so I started learning about how to value companies, and I learned about cycles. And what was really funny about the tech bubble is that if it wasn't tech, it was really cheap. And I read enough to know that these things are mean reverting. And I bought a bunch of cheap value names personally. I remember one of the first things I bought was Philip Morris, when it had north of a 20% dividend yield and it traded at 3 times cash flow. I probably wouldn't have a hedge fund today if not for me being a 17, 18-year-old at the golf course with my dad, telling all his drinking buddies to buy some Philip Morris. And at the time, they were all buying like Yahoo and CMGI and ICG and stuff that doesn't exist anymore. And fortunately, enough of them bought some Philip Morris because it ended up being like a 10-bagger in 3 or 4 years. And they said, "Hey, Kuppy, you're good at this. Here's some money. Why don't you put it into a fund?" And that's kind of how I got to have a fund. But I had a few of these. Methanex was another great one. When 9/11 happened, we were in hotel stocks. I was just giving out stock tips, basically, my dad's golf buddies. But
so that was like after 9/11 happened, you
right. I mean,
picked up like hotel stocks.
Yeah, December of '01, January of '02. I bought a bunch of hotel stocks at 10, 20 cents on replacement cost. And fortunately, occupancy rebounded, and they were multi-baggers for me. And I always remember telling my dad's friends to go buy these things. The problem, though, is that you'd have 20 different conversations with 20 different people, and you forget who you told what to, and then you forget to tell them to sell. And it just ended up being a better process to have a fund. And so I launched the fund my senior year of college.
Right.
Fortunately, I'd made people some money, and they trusted me.
Yeah, and I think they really like enthusiasm of young people and want to do something. If they trust you, I can imagine that that went well.
Well, young people also have no idea the stuff they don't know, so you're kind of dangerous.
You have no fear, right? You have no fear.
Well, yeah, you don't know common sense.
Yeah.
Look, but if you look at those sort of investments, they weren't deep dive. Obviously they're deep dive value, but they weren't deep dive spreadsheet investments. There was no differentiated opinion that 20 tabs of a spreadsheet could let you know. This was just basically, is 3 times cash flow good enough for Philip Morris, or will people eventually go to hotels in Manhattan again? This wasn't like rocket science and stuff.
Right. And so Philip Morris is, again, it's pretty attractive, maybe not that attractive, but it's pretty attractive. And are other things reminding you of 99, or do you think?
Well, right now we're in the bubble of all bubbles. At least in 99, 2000, you could look at some of these tech stocks and say, no one knows what the internet's going to look like. These things could become super dominant businesses. And, this business is $1 billion, that business is $2 billion. Like, it could become a 50, 100 bagger if the internet turns out this way or that way. There's a lot of unknowns. Here, the bubble is Dogecoin, or it is, AMC, where we know cinema is dying. We know it's overvalued. We know that management thinks it's overvalued because they can beggar the share count. Everyone in the entire ecosystem knows this is dumb, yet there are people who are buying this stock. It trades tens of millions of shares a day, and it defies all logic of everything I've ever learned about business and finance. AMC will not become a dominant business. AMC will be forgotten in history. And you can say that about Dogecoin. You can say that about a lot of the weird assets that have multi-billion-dollar valuations, have no revenue. All these SPAC EV companies and whatnot. I mean, at least back during '99, these companies had rapidly accelerating revenue, and they were dominant in their own little niches. And occasionally, someone like Microsoft would overpay and buy one of these things. It's a different sort of bubble, and it defies all sense and logic.
Right. But so I find that pretty challenging that fundamentals, I mean, it's not that they don't count, but sometimes you need a lot of patience. And the last few years, they really don't seem to be working that well. I think there's even an AQR paper about it, value is dead or something. And
I would agree with that.
Well, no, please.
Value always works, and value, if you're correct about the valuation, it's getting resolved these days, not through the open market forces, though sometimes it is, but management takes it private, PE takes it private. In 2018, I put 11 positions on, and I had 5 either go private or someone launched a hostile bid or something. I mean, basically half my book disappeared over the course of the year at, large premiums. I think the company sold out too cheaply, but you wake up in the morning and you're up 75%. It's not a bad outcome. Last year I had a few get acquired from me. I'm sure, this year is still young. It looks like one of my companies has a PE fund after today. The stock's up 20%. And I think valuation will get solved that way. It'll get solved through buybacks. It'll solved through cap structure changes. And then, look, value seems to be working. I mean, I've had 2 consecutive huge years. It's working.
Sure.
I think people look at value and they look at something like IBM and they say, look, it has a big dividend yield, it's cheap on cash flow, but everyone knows IBM is dying. So it is cheap, it's been cheap, it will eventually go poof. That's kind of how I think of value. It's some boring, dying business.
No, and if I think some of, you look at this inflection points, I've got like an interesting example, I think, is like Joe, this real estate company on the Florida coast, right?
Right.
And I've known about that company for a long time because it was like a big battle of the minds between Berkowitz and Einhorn, I think right after the great financial crisis. It was like 90 or 80 per share before the financial crisis. Totally crashed. They got into sort of Berkowitz was a big long, and he's the chairman currently, I think. And yes. Einhorn went short with a public piece, and he was super respected at that time because he crushed it in the financial crisis.
Einhorn was right. I mean,
but it did nothing nothing. It just declined for like 9 years straight. And I think you got in at like 10 or 15 or something. Just went up, it's up to 60 or something like that. Maybe it's 40 now. And you kind of have a knack for finding these ideas that, inflect. And I don't know. How do you do that? How do you know that it's going to change? Something's going to change in the thesis, because I think this is a perfect example. It's like 9 years of declines.
Well, I mean, something like Joe, I think everyone knows, I don't think there's any debate at all that the net asset value of their 175,000 acres, the net asset value is somewhere between $100 and $200 a share. I think there is no debate about that. Longs, guys who are on the sidelines, guys who are short, I think everyone agrees with that fact. The question really is what's going to unlock the value. because there's a lot of stocks that trade at large discounts to some of the parts. And you need a catalyst to unlock it. And I'd say the discount got unreasonably large at Joe. Normally these things trade at 70 or 80 cents on the dollar. So Joe should have been maybe 100. But, it traded down to 16 because there was no catalyst. And it didn't appear that there ever would be a catalyst. And money has a value to it, and people want their money working hard for them. And so no one wanted to lock it up for what turned out to be 20 years of no returns. I mean, I think the market got it right. But what the market missed is that new management came in the middle of last decade, and they took a different approach to the running of the company. Previously, management built these giant master plan communities, a lot of CapEx up front. They sold off the beachfront lots, and then no one wanted the inland lots. And they ended up with nothing they could monetize. They just had acreage. The new guys said, let's make this a destination where people actually want to be. Let's make this a retirement community. Let's make this, each individual community having a different feel. So you have some woodsy ones, you have ones with lakes, you have ones that are on the shore. They still have 200 miles of coastline to sell. And they started selling lots, and they got to a critical mass. They really focused on the commercial side, so you have recurring revenue. And of course, you always have the chicken and egg problem. No one wants to move to the middle of nowhere if there's nothing to do. But you can't get high quality tenants of restaurants if there's no customers. So you have this chicken and egg problem where you're going to have to suffer on one side or the other to subsidize someone. And they subsidized an airport that's now a rapidly growing airport. They subsidized commerce. They did a lot of things to bring people in, and they started ramping lot sales. I've been going up there every few years checking up on this stock. I knew it was cheap, and I wanted to catch the inflection. And what happened in my mind was that when COVID hit, people realized you could work from home. And it's one of the most beautiful places in the United States on the coast there. It's one of the most beautiful beaches. And for people from New York, it's zero tax. And so you started having a real migration of people. And I was up there last summer with my wife because we were hiding from COVID. Because Miami, where I was from at the time, they had lockdowns, and the Panhandle, they just kind of ignored it all. So we rented a summer house there, and we started talking to some of the brokers, and they started saying stuff like, we never ever had New Yorkers coming down. Now we're only selling to New Yorkers. New Yorkers are paying 3 times what the guys from Atlanta was willing to pay. And then you went to the county clerk, and all the data's there, all the sales. We said, wow, home prices have tripled this year. And then you could queue in on every lot that Joe sold because the data's there. And you can say, wow, I see this, it was growing 20% a year sequentially, let's say. It started growing 100% a year. So you have all this analytical data, and you say, this is inflecting. We sat down and talked to management, and they were super optimistic, whereas a few years earlier, there was so little going on. They just kind of hung around for a 3-hour lunch with us. They were actually busy with stuff. It was just obvious that it was like inflecting. And so I made it my largest position, about $19. I never sold a share when I got almost to 60. And the last couple of weeks, I've bought a lot more in the mid-low 40s. I think that my model for cash flow is way too conservative now, whereas 6 months ago, people told me I was too aggressive. I'm going to have to redo my model very soon. But I think I'm buying this at a mid-single-digit cash flow on where the cash flow is in 24. And I'm getting $100 a land for free. If you think this cash flow stream is worth 30 times because it doubles every 2 years, then I don't know, the operating business should be 200 and the land 100. It should trade at 300 today. I'm not saying that's the right number, but it's just materially mispriced in any metrics you can use. And so it's the cheapest stock on the board, and it's my biggest possession.
You actually visit there with county clerk to look at those sales?
Oh, that's all online.
Oh,
that's all online.
You can find it online, okay. But it's not the company's materials or...
No. The company does pretty... They do a poor job at investor relations. I find that a lot of the things I invest with, the business runs just fine. It's just that management isn't very good at telling their story. Joe's done some things recently. I mean, they have 40 or 50 projects on the go in commercial real estate. Once a month, they fly a drone, they put out a YouTube video. I think they get about 10 people who watch those YouTube videos. I check. No one watches it, but it's there. It shows you all the progress on all their projects. It's amazing how much is going on. I mean, people tell me Joe is a sleepy land bank, and that's what it was 10 years ago. But here we are. They had 122% year-over-year revenue growth in Q1. I think they're going to report Q2 pretty soon. I think it's going to be some massive quarter again. How many SaaS companies grow at 100% year over year? Like none of them. And they all trade at stupid multiples on revenue. And here you are, you can buy this at a single-digit cash flow multiple. It's mispriced. And everything I do is find something that's horribly mispriced and get there when the business inflects. And then I don't try to overthink it. I don't day trade it. I don't come in and out. I just own it until the rest of the world realizes it. I think this is a 10 or 20 bagger from here in the next few years.
Right, and then now I'm thinking, because you've got quite a remarkable view on inflation. You think it's here to stay and it could be bad. Land banks are pretty interesting in an inflationary environment. Does that play into your
absolutely
position? Or?
I mean, the reason it's working now, I mean, I think management's done a very good job of operating the business, but if you have no demand for your properties, there's nothing you can do. We're in a unique inflation, and every inflation is different. If you look at historical inflations, this one's going to be odd because a lot of the past inflation, you had someone go off the gold standard and it all fell apart. Here, we don't have any of that thing that's tethering us to anything. I kind of think that the Federal Reserve will keep interest rates suppressed while inflation goes crazy. And so if you're an upper middle class guy with some extra cash sitting around, you're not going to buy a muni bond. What you're going to do is go buy your summer home for your family, because you're going to finance it at 3 and it's going to appreciate 20 a year. It's the best carry trade you could ever put on. And I think people are going to buy second homes. They're going to buy some homes for income. They're going to do things in real estate. I think real estate will do quite well. As long as you can control and reprice the rents. But for a lot of people, I think they're just going to buy a second home. And I mean, like I said, I think it's one of the most beautiful parts of the country. I assume people will buy a second home in the Panhandle. And so, definitely that backdrop. I mean, I try to combine a macro view with some corporate view. So it works.
Yeah, and as well, I'm an outsider to the United States, but this whole tax thing seems to have a life on its own as well. It seems to gain some critical mass. I hear it so often that people are moving from New York area or New Jersey to Florida. I'm surprised how often I come across it.
Well, you have, a real bifurcation in America now, culturally. You have the coastal cities that have one culture. It tends to be liberal, it tends to be high tax, and it tends to be high crime. And these cities tend to be horribly mismanaged compared to 10 or 20 years ago. There's like trash in the streets and sewage, and the police aren't allowed to do their jobs. And then you have places like Florida that are reasonably well run. I mean, Florida was a laughingstock 10, 20 years ago. And here we are, they've picked up their game, and the big cities have fallen apart. And when you have 1,000 or 1,500 basis points differential in terms of tax regime, and increasingly business is mobile, it's intellectual capital, it's not physical capital. People are going to go where they're treated best and where the capital is treated best. And I think you're going to see a long-term demographic move. And then besides, who the hell wants to be in the Northeast and cold 6 months a year? Like, Florida's beautiful.
No, it would be great to be in a better climate, and Netherlands isn't that great on that front either. Let's see. So I happened to once be in a company you bought as well. I think, well, I bought it before I heard you talk about it, and it was Galaxy Digital. I think it's kind of interesting because I got in at 1 or below 1, and it was a really cheap sort of an option on like cryptocurrencies doing something or coming back, because it was when it was kind of out of favor last year or some maybe early last year or the year before that, and maybe it was even a net. I'm not sure, but anyway, I bought a little bit. And I think I sold it at 4 or 2 or something, and it was a great result, but it was at a tiny amount. But it went to like 15 or maybe even 40.
Yeah, I sold too soon.
I get sick looking at it. I think you sold it too soon as well. But do you have?
I bought mine between 75 cents and about $1.25. At the time, it was trading for less than the value of their cash and their Bitcoin they owned. And I was turning pretty bullish on Bitcoin back then. This is when Bitcoin was like 6,000-7,000. And I was turning bullish on Bitcoin. And so I was able to buy a bunch of Bitcoin at like 2,000-3,000 by my math. And it just seemed like a good way to play crypto in general. And, we actually became one of the largest shareholders. It was basically a company doing a buyback. Mike Novogratz buying the open market and us.
Yeah.
We ended up buying a couple percent of it, and then it did what we expected it to. It went from a discount to net asset value to a decent sized premium to net asset value, and I wasn't all that enamored with their banking business because I don't know how you value a lot of things that they were investing in, and they seem to be taking impairments and losses pretty regularly. Trading coins and SG&A seemed pretty elevated to me, and I just said, this isn't what I signed up for. I want kind of a pure play on, Bitcoin, not so much, owning into a merchant bank that seemed to be fumbling along. And so we tossed ours at about 2.5 times net asset value, and we bought Grayscale instead. I guess I should have held the Galaxy, but I don't know. I sold mine about $4. It was like a 4-bagger in 3 months, 4 months. I mean, you can't be too upset with that.
Yeah.
And then it gave me a lot of capital, and I just kind of pyramided the capital into the Grayscale, which ended up being like another 4 or 5-bagger.
Right. Yeah. So you just take that, as a win, and you move on, and you don't mind that sometimes happens that people buy this stuff off you as a value investor. You get it really cheap. You make 100%, or in this case more, and you don't mind if it goes on a huge run.
No, because that's not what I do. I mean, I buy undervalued securities that have a macro tailwind, or they have some sort of corporate change tailwind. Something's happening right. And when it gets to, either the business model changes, or they do something I don't like. Yeah. And with Galaxy, I just didn't understand why they were taking losses trading crypto when crypto was in a bull market. It boggled the mind that they had 2 or 3 consecutive quarters where they lost money effectively in a long crypto fund while crypto was going up. I said, this isn't right for me. This isn't what I want. So this was one where I thought the strategy was floundering, so I tossed it. But usually, I either something changes the business, or something it gets to a value that I wake up in the morning and say, if I wouldn't buy it here, then I should probably sell it, and sell it. And if you buy the things I sold, the winners, you'd probably have a very good track record. But I don't like to risk my capital. It's very precious to me, and I'd rather cycle into something that's very cheap rather than try to squeeze a little bit more out of it. Just, the way I do it. I'm not saying it's the right way to do it. It's just the way I do it.
Yeah. One time before, I had a similar experience with a company called Tellurian, and it was like super cheap thing, and it got acquired by like a big star CEO, and I sold it way too early, and this kind of reminded me of it because it's like Novogratz is a little bit of a star, and then people can get like really excited, and I don't, I felt stupid for doing that twice.
Don't feel stupid. If you made money, then you won.
Sure. Sure.
Look, I thought Novogratz would promote it. He promoted it. I just kind of lost confidence in what was happening there at the business. It is what it is. I've had a lot of these that I've sold. They go up a lot.
Right.
It's good. It means I was right.
Yeah, well, absolutely. And then maybe I'll tie this into, you've recently launched a research server called KEDM. It's at kedm.com. And it's really interesting because it has like 15 to 20, no, maybe it's even more, like event-driven screens where you flag a lot of interesting opportunities. And maybe to explain it a little bit better, it can be like more vanilla things like companies that do a lot of buybacks or cluster buying, insider buying, but also very hard to find things like changing CEOs. And you have two screens, a fallen angel and left for dead screen. And I think those are a little bit about what we just talked about, like your inflection investing. Can you maybe tell us a little bit how you use those screens, or because I think that's the source of how you find these things, right?
Right. I mean, in the end, when you look at the world, most securities are roughly fairly valued. There's a lot of really smart people kicking through not that many ticker symbols. And increasingly with computers, they're using AI, and I mean, we're all going to be obsolete. So what you need some sort of fundamental change at a company that the computers don't see. And either that's some sort of macro inflection, we just talked about that with St.Joe. The computers just weren't scanning the county clerk records in Bay and Walton County, Florida. Or you're going to have some sort of a corporate event where value's unlocked or the direction of business changes. So, I think one of my favorite ones is the CEO change. CEOs change all the time. Guys retire, guys get fired, guys die. And every time a new CEO comes in, they're often going to change the trajectory of the business. Sometimes it's better, sometimes it's worse. And so you can look at that and, something's going to change. I mean, Joe, the new management, I think, has done a phenomenal job. I mean, look at some of the big winners from the last year. GameStop with the CEO change, Bed Bath with the CEO change. These are situations where people have given up on these companies, and the new guys came in and convinced the street that there was a future. That's one scan that we create manually. It's you can't pull it up on Bloomberg. What we found is that stuff that's on Bloomberg, it gets picked over pretty fast. Spinoffs. There's too many guys following that. Foreign spinoffs, meanwhile, there's no one following it, which is surprising. But a lot of these screens that we're putting together, and increasingly the ones that we hired a guy, we're looking to hire a few more. The screens that we're going to be creating are screens that change a corporate trajectory, and the data is not freely available. We have to build it ourselves, and I think that creates a lot of opportunity. The things that change trajectory is cap structure, management. There's a lot of these. I mean, even something simple like a cluster buy, you're not changing the trajectory, but you're seeing, hey, a couple different people on the inside who have better data than me all agree at roughly the same time that things are getting better and they want to buy. But all of these sort of screens, I think, can be used to find opportunities and basically to narrow the list of securities you want to spend your time on. Because you want to be a productive person. And we built this not so much to sell a product, which is very different, I think, from most newsletters. But we really built this because I wanted the data, and I asked a friend of mine to put it all together for me. And then a bunch of my friends wanted the data, so we started distributing it to them. And then we said, hey, let's put it into a PDF and sell the data so that we can hire some really smart people and get better data. And it's kind of like crowdfunding my research effort in a way.
Right. Yeah. And I think these are some of the best services that are built around people's things they want themselves or use themselves. And they're not always the most commercially viable or something. But yeah, I think they're like the best. And yeah, so
Yeah, this
something else.
is, I mean, it's designed and formatted exactly how I want it. And we've never really cared what anyone else wanted. And, you know, I'm really happy and lucky that it turned out other people want it.
Yeah.
And then we put together a chat room for the subscribers. And I mean, any given day, you have a few hundred people in there talking about event driven. And there's too much in the world for any one person to follow, even a team of analysts. And here we are with very smart people having detailed conversations about various events that are happening. I mean, I could read a thread and I'm up to speed rather than wasting a day of my life learning about stock. It's phenomenal what the value of that community.
So you're getting value from the chat as well,
Yeah.
Because I think you were already somebody who would talk to a lot of other people and have a very good network of investors.
I mean, yeah, absolutely. But a bunch of my friends joined the chat. So, you know, right. People that maybe didn't know each other, or, you know, one guy would send me an email, I'd send that guy an email, someone else. Well, now we're just all in a thread together. It's just better.
Cool.
It's all in one place. And people who are watching, they have opinions. And I don't know, I think it's a really valuable resource for people that want to do event-driven trading, which is a very narrow subset of it.
Yeah, or I think there's a lot of people who will use like a select few of the screens, but those will be very useful because some of them are like one I wanted to highlight a little bit is currently I do a lot with specs, and well, you're seeing a lot of problems there, and so you've been flagging like unlocks, right? Because those are great to short because specs are kind of overloaded with dilutive securities, and they don't always do so well after the business combination. And then the unlock, when the insiders can get out, that's a real great moment to short, in your opinion. And I think you also did some work, or you're doing some work on, because it's actually not so straightforward, right? When that unlock actually happens.
Right. I mean, when you think of these SPACs, you really should think of them like an iceberg, okay? They IPO 20 million shares. Founders get some free shares or free warrants. There's warrants given out. And then they announce a deal and they do a PIPE for another 50 million shares, and they give another 200 million shares to insiders. So you look at that 20 million shares, but in reality, you have 300, 400 million shares outstanding, and you're just looking at a little tip of it that's setting the incremental price. But then when it works backwards, 30 days after the deal closes, you're going to have the pipes, they're allowed to sell. And what we've seen a lot was that when you did a merger with an EV fraud, back in January, you announced, we're buying EV Fraud Co., and the stock went from 10 to 40. And so everyone who's in the pipe, they might not sell at 40, but they'll sell at 25. And so it was a really good return on capital for people to lock up their money for a few months. So a lot of people did a lot of these pipe deals. Well, it turns out, buying a pipe in a fraud is a way to lose money. And so now the stock trades at $8, and then the pipe unlocks and it trades down to $5, and guys are losing cash. But you have that wave of selling, which are guys that really don't want to own this. They bought it because they thought they were going to rip off the public. And then you have the insiders, and usually that's in various tranches, and it's never very straightforward. It's always very if then. 180 days after the deal closes, if the shares are above this price, and after the second earnings release, if the shares are above this price, then X number of shares, and the founders can't sell for another period of time. So if you just read the document, and the document's somewhat cryptic, but if you read the document and keep track of when all these people are allowed to sell, there's moments in time where these things waterfall 20, 30%, and it's literally free money. Like, you just got to read the damn document.
And you mean in the sense that the float really increases, like by an incredible amount, or what do you mean by a waterfall?
Well, so the thing is, so you have this public security that's trading millions of dollars a day, that has a supposed market cap in the billions,
right?
And everyone involved in the thing, everyone in the ecosystem knows it's worthless. outside of the cash on the balance sheet that's probably going to get stolen, there is no value. Okay.
Right.
And so everyone wants out. And a lot of the people, the pipe guys, they paid 10. But everyone else in that dynamic often, has free shares effectively. Because, the company has a few dollars, invested in it. Employees got their shares for free. Founders got their shares for free. Early VC maybe sent 50 cents a share. So if everyone sells at $2, they're still coming out ahead. So it's just a question of how do I blast out and turn something that's totally worthless into something, that is worth something like dollars. And so these guys are trying to get out as fast as they can. And they're often just blasting out. Because remember also, whereas retail guys have no idea what they own, the guys that actually own these shares and own millions and millions of shares, they've read these documents. And they know that 15 days from now, their buddy gets to sell, and another 15 days, the venture capital guy, they get to sell. They know how much money is coming. How many shares are coming behind them. They just got to get it all done to beat the other guy out. And so, look, it's literally free money sitting on the screen. You got to read the damn document. We put together some of this data. It's through these SPACs, and it's too much stuff. We've started the process with IPOs, and we're now working on SPACs. We hired a really smart guy to do it with us, and we're hoping to hire, like I said, a few more guys. Now that we put a paywall down and have some revenue here, we could hire more people and make the product better. We intend to dramatically increase the quality of what we're producing and add value for people. For anyone who's watching this, I recommend taking it for a free trial. We're offering 4-week free trials. Go to kedm.com. I'm sorry I'm marketing in the show, but I believe in the product.
No, me too. I think it's great, and people should definitely check it out. Maybe one more screen. I'll flag. Maybe we can talk quickly about some companies you like, if you like any.
Yeah, sure.
You also do like the short squeezing, which is super popular since the GameStop thing.
Short squeeze is another proprietary screen. In the end, there's lots of places that will show you the 50 most shorted securities, and people short stocks often because they're crap. But lately, guys that are short these things are getting run over.
Historically, it's like a terrible strategy to go long highly shorted names.
Yeah, but they tend to be more volatile because of the short interest and the potential for a buy-in. We put that screen out there because it's been moving markets, and I think it's very important for people to look at that every 2 weeks. The data gets re-updated and say, hey, what's happening, and what are the names that potentially could have an explosive move. But we've traded some of these. We've made a lot of money out of some of these. But I wouldn't say, you buy Kedem for that. I'd say you buy it for your CEO change and all the other stuff we're putting together that's truly proprietary stuff. And
do you think it changed the long short, how it's being run?
Yeah, for the life of me, I don't know why people are short. I can understand, this 20 million shares in the float and 50 million are unlocking next week. You probably want to be short. And you can be short by, directional short. You can be short by selling calls. You could, short common and write puts against it. There's a lot of ways to harvest that, window of time where a lot of stock is getting sold. And you're taking a very truncated amount of risk time-wise where, if you kind of know when the event's going to happen. But I have this view called Project Zimbabwe where I think the stock market's going to go up a lot. I think you'd be ludicrous to show up to work saying, then over the next year, I think the stock market is going to go up a lot. 2 years out, it's going to go up a lot. 5 years out, it's going to go up a lot. Why would you be short? Why would you be betting that it's not going up when the government has, as clearly as possible, told you that they intend to make it go up? And I just don't understand why people would go and short the market. And I really don't understand why people would go and look at a security where, half the shares are short and decide that that's the thing they want to short. What we've learned through the last year is that social media, including Reddit and Twitter, and these guys all team up. I don't know how they do it, but they all team up on these names, and they make the short sellers hurt badly. And they tend to go, I mean, it's one of the only, normally Wall Street exists to take money from the retail and give it to the professionals. It's one of the rare times in my career where the money is repeatedly coming out of the pockets of the professionals, often some of the smartest professionals, and it's going to the retail guys. It defies logic, but it's a fascinating dynamic to watch. And I think, if you're going to be shorting, you should be really aware of the short interest in your names. And when that short interest starts getting above 20%, you should get really scared.
Right. Well, yeah, I think some professionals are benefiting as well, but there's definitely some getting hurt.
Oh, yeah.
Actually, GameStop was a sort of a wake-up call for me, because I think I got hurt on the same phenomenon, shorting things like Tesla, Neo, and just you limit your losses, but you don't know why you're losing. But I think it was kind of this similar dynamic, a little bit slower, but yeah.
Yeah, I mean, I don't short. I'll buy some puts occasionally, but I just don't short. Outside of really truncated things like an IPO unlock or a SPAC unlock or something. Yeah, it's just a way to lose money.
It's definitely been a headache for the last many years. Yeah, it's a long time ago that worked great. Let's see. Yeah, you've got our great stuff like rights offerings and privatizations, but now that I have you, I know you're a big bull on oil. I think that's super interesting. Are you buying any companies? Or I know you're buying futures a few years out, so you're thinking like short term, like 1 year, 2 year may go anywhere maybe, but like longer term is going up. Are you buying companies as well? Because those are usually leveraged to longer term oil, or just futures?
Well, I own the 25 futures piece. I own the futures call options. I also own the 23 90 by 100 call spread for these. That's actually a bet on the futures price of oil. I think
so. The call spread is you buy a 90 call and you sell a 100 call, right?
Correct. Okay. I came into that for about 63 cents, so it pays off 15 times, which is a pretty good return in my book. I'm not the sort of guy that buys a stock at 20 because I think it's going to 24. I mean, we're looking for multi-bagger upside in everything we do. We're not locking up our capital. But in terms of oil stocks, I'm not a geologist. I have no special insight. We own one producer right now. We actually bought it as a net. It's more that the sum of the parts. And the company Sandridge, I was buying it at 75 cents, $1 when they had $2 a share of cash, and they were profitable and they had no debt. Today the stock's at almost $6. So, it's been, it's called a 6 or 8 bagger already.
I think I've heard you talk about it. It's traded for less than the value of its headquarters at some point, right?
Correct. It traded for less than the cash in the headquarters of the balance sheet. And, so it was a net that was profitable, but oil prices were terrible and it was barely profitable. New CEO came in, cut costs. I really liked him. The market didn't realize that there was a lot of fat there to cut. We were pretty low there. And so they've taken their LOE way down, their break-evens way down. They consolidated some royalty interests and, basic block and tackle. They sold out the headquarters.
A new CEO came in here as well, so that hit one of your things you like to look for.
Often we'll have a few of these screens overlap. So Sandwich, it's on our Fallen Angels screen. Fallen Angels is stocks that are down a lot over the last couple of years, where they trade for way less than fair value. You just don't know when you're gonna get paid, but you kind of know you're gonna get paid. And if you look at the Fallen Angels, I think we probably had 30 names that have left that screen in the year we've had them now, and almost all of them were multi-baggers. I think we've had one that we took off break-even-ish or small loss. It's just a great place to play. I mean, that's kind of a proprietary screen too. But the sandwich has been there since it was about $1. I guess that's $6 now. They've got over $2 a share of cash. At current energy prices, they're making north of $2 a year in cash flow. So stock trades at $6, and they'll have more than $4 of cash at year end. It's mispriced. I mean, it's internal decline, but the internal decline will give you more than today's price. I wouldn't say you should buy it here. I mean, you probably should never buy something that's up 6 times in a year. I've actually sold some, but I think it's going higher.
Right.
But
and then I wanted to ask you one question about your CEO thing, right? Because I kind of learned that when a new CEO comes in, like the first quarter, he'll come out with all the bad news and pin it all on his predecessor. Do you find that that's true, and do you avoid that quarter and get in later, or do you just take that pain?
There's a usual fact pattern where, look, if a company's doing well and a CEO retires, usually the new CEO is handpicked. He's not gonna, say something bad about his former boss. But if it's a situation that's been a mess, like Sandridge was, I wouldn't say they didn't say anything bad about the old guy, but they took a giant big bath.
They took write downs and stuff.
Yeah, but when you look at what the new CEO did, he did exactly what you would do with energy prices low. He said, we're not drilling anymore. He fired everyone in the drilling operation. They cut a lot of costs. He did exactly what you'd expect the CEO change scan to say. He took the company that was going in one direction, where they were drilling uneconomic wells, and they were just doing it because that's what they were doing. And he took it in a different direction, where they stopped drilling and they stockpiled cash and they cut costs. He just left the company, the new CEO in place. We'll see on the conference call in about 2 weeks what the new plan is. The new plan might be good, it might be bad, it might be steady Eddie. We'll see. But you were asking, do I own a lot of energy companies? No, I do not, because they tend to be destructive of capital through the full cycle. I mean, obviously, at the bottom of the cycle, you want to own them and probably be selling them around here. I believe the reason oil prices will be higher in a few years is government interference and regulation. I wouldn't be surprised if there's a carbon tax on energy extraction, if there's higher royalties, much like they banned drilling on federal land, pipeline changes. There's going to be a bunch of things that make it very frustrating and annoying to be an oil company. So if you make it difficult to be an oil company, the price of oil is probably going to go up because they're going to drill less. So you really don't want to be an oil company if the government says they're going to kind of screw you. You just want to own oil. Biden has said he wants to have an energy crisis. So, if the president has declared an energy crisis, he's probably going to create an energy crisis. You don't have to be very smart. You just basically listen to these guys. And so we own that. We own quite a lot of energy services. Not so much that I'm super bullish on energy services, but a year ago, oil went negative and everyone stopped drilling. They stopped doing anything except for basic maintenance. And it's a year of deferred maintenance now, and guys are going to start spending a little more. And so Wall Street works on the first and second derivative, rate of change. And the rate of change is positive because coming from no exploration to some exploration, bullish, and it's accelerating, the second derivative. And when exploration stopped, a lot of these companies went bankrupt, and the equipment was still there, and it came out of bankruptcy with minimal debt. Some of them came out with net cash, and you're buying a bunch of equipment at 10 cents on replacement cost. And in prior cycles, at the top of the cycle, the equipment's worth 2 or 3 times replacement cost, and I came into it at 0.1. And so to get to 3 times replacement cost, you make 30 times your money. Plus, hopefully they create some value along the way. I have a feeling this cycle won't have the same amplitude as prior cycles, but getting to half of replacement cost of 5-bagger, that's pretty good still. And these companies are profitable today at very low levels of spending across the industry. because a lot of competitors went out of business and they have a bit of pricing power for the first time in a while, and they don't have huge debt service. Plus, through bankruptcy, they're able to fire a lot of people they need. So I don't know, it's not a bad place to be. But once again, a lot of these things are up a bunch. So what I try to do is buy right at the inflection when it's cheapest. And you take a little bit of a leap of faith, but you get in so cheaply that you don't get hurt when you get it wrong. And I mean, I get stuff wrong. I get a lot of stuff wrong. And so, these things are up some. I'm not sure if you want to be chasing and buying, but if you're long, you just kind of ride it.
Right. So
see where this cycle goes and kind of fine tune the portfolio as more data comes.
So I think kind of your strategy, you take like a lot of like smaller kind of losses, because you're buying already at a very low level, and then sometimes it just doesn't work, and then you're like, okay, it's not going to inflect, and you cut it, and then you have your winners, and those are big. Is that kind of your?
That's how it's supposed to work. It doesn't always work that way, but
right.
No, look, if you buy a bunch of equipment at 0.1 times replacement cost, well, no one's buying new equipment because they could buy used equipment cheaper. So there's no new supply coming in the industry, and 0.1 replacement cost is really cheap. Could it go to 0.05? Yeah, why not? You don't really know, but if you have a tailwind and you know that demand for the equipment starting to pick up, then probably not going to go too badly against me. Could there be a relapse? If countries lock down, oil goes back to 40. Yeah, sure. That's kind of the risk you take with anything, though. But if you're coming in as cheaply as I'm coming in, if the thesis gets pushed back a year or two, the thesis is still alive. And if something dynamically changes the thesis so that I know I'm wrong, I'll get out. But I got in so cheap, I probably don't lose much. If you look at a lot of the stuff I invest in, and there's always exceptions where I get really badly hurt. Mostly I lose 10%, 15, 20% at most. And some of them, it doesn't work out and you make 20% because you bought so cheaply. And the winners, you're going to make multi-bagger. And if you put a few of these plays on your book at a time, and I don't have that many, I usually have 6 to 12 themes, and usually the top 5 are most of the book. But if you have 2 of them work each year, and you have 2 kind of go nowhere, and you get one wrong, you're going to have a 100% year. Like that's kind of how the game is supposed to work.
Right.
And the goal is to get triple-digit returns without taking any risk or taking minimal risk. Right.
Yeah. I think this whole energy transition, it's going to be chaos. There's going, so much change. There should be opportunity. It's what's going to happen to supply. It's anyone's guess, but I don't know. Did you follow what happened to Royal Dutch Shell? They got like a court order basically.
It's a rogue judge. It's in your country. And a rogue judge decided that Royal Dutch Shell, the 100-year-old company with, tens of thousands of employees, they're no longer allowed to export for oil.
Right.
It's like a judge.
They even have to sell like half of their assets. Well, that's basically what it comes down to.
Right. I mean, and a judge anywhere can rule anything, and I assume they're going to appeal, and I assume it'll get overturned, but it sends a very scary message to any energy company that is making investment decisions. Because, energy, it's not like you turn on the faucet at your house. This is, even shale, you're making multi-year decisions. And in the case of the big projects that the integrated oils like the Shell were making, these are 10-year decisions from start to really production with lots of engineering. And if you are worried,
if shale starts to decline, I mean, because that's can turn pretty fast, and we've gotten used to that. But it didn't used to be like that at all.
I think you're going to have a lot of things that constrict future supply growth. Remember, oil decays. I mean, you have a decline curve.
Right.
So globally, a few million barrels, 5 to 10 million a year decay. and then you're going to have less capex, and you should have an energy crisis.
Right.
And in the past, the oil companies would just ramp up production. But if you're not allowed to make long-term capital investment decisions, and you don't have, that's for the big guys, and the big guys in America, they have pirate activists take over their board and tell them not to produce any more oil. Well, then who's going to produce oil? I mean, the Saudis will produce oil, and that's it.
And I think they're in decline as well, but just naturally.
Maybe. No one really knows, but I mean, in the end, you're going to have less, you're going to have more concentrated production from fewer guys that are going to dictate the price. And I don't think you're going to have the supply response we've seen in the past, where oil goes up and people go to their bank and they say, look, oil is 80 now. We know, we've done the engineering work. We know what the data is. Give me $1 billion to produce it. We're going to hedge 1/3 of the production for the next 5 years, so you're guaranteed to get your money back. And it's a risk-free calculation that the bankers can lend on. Now, the board of directors is scared that pirates are going to take over the company, so they don't even want to make a 5-year plan. They don't even want to produce oil. The bank is scared that someone's going to go protest outside their headquarters. So they don't want to lend on oil. Like, how are you going to get new oil? I mean, it'll get solved, but it's going to get solved by people that have much higher return hurdles. Guys like me that are going to have to look at this stuff and say, I don't want to make LIBOR plus 500. I want to double my money every year. And when I see returns like that, then I'll commit capital with this. And so I think you're going to see a higher energy price. And that's why I'm on the futures and the futures calls. I think it's a much cleaner way to play this than, you show up one day and your energy company just got hijacked and they're putting up windmills. Like, I don't want that.
Right. And so this is pretty unusual for you, actually, right? To do like a straight future commodity play, or
it's quite unusual. I think the last time I did something like this was in like 2004 when I bought silver futures at like $4. And they were like a 10-bagger in a few years. And one thing with futures, and you have to keep this in mind, your broker will give you enough margins that you can bankrupt yourself. I don't leverage this up. I'm not going out there and margining out. If I decide I want to have X number of dollars of exposure to oil, I don't leverage it 3 times. I put it on dollar for dollar. I treat it like an equity. Because as we've learned, oil can go negative, and you'll get taken out of the game if you're levered 10-1. So just keep that in mind when you're playing at home. I mean, I'm not going crazy here.
Right.
But no, I think the last time I did this, and there might be one other time. I bought some gold futures. I bought gold futures a few times, but
okay.
The first time I bought like long dated out of the money stuff, I think it was 2004. The last time I did it, and silver was very good. I mean, once again, you had a situation where it was unprofitable to produce silver, and there was no new supply coming, and there were a number of reasons why demand would go up, and we got it right. And when you look at it, I owned silver, but I also owned like Pan American silver, and I owned, that one was a success, but it wasn't a 10-bagger. And some of the other silver companies I owned, they got the geology wrong, or they got the permits wrong, or they got the mine plan wrong. For every Pan American, there was like a 5-bagger. A lot of these went nowhere. A few of them went down in a silver bull market. You don't want to own the producer. If you believe in the commodity, you go buy out of the money calls. I mean, these oil calls are like 12 implied vol for 2025, and we know oil is a 30 to 50 realized vol product, and I'm buying 5 years out for 12 vol. It just seems wrong to me.
Right. So it's super interesting idea. Maybe we do. I wanna let you go and enjoy your day. But maybe if you have like a last idea or something that you think is really great, love to talk about, or I'm putting you on the spot a little bit.
I mean, we talked about a bunch of stuff I like.
Okay.
Honestly, I haven't been buying much lately. I'm one of those guys that buys it when everyone's selling, and I tend to sell it back to them when it's gone straight up. And I mean, we're 15 straight months of the market going up, pretty much nonstop. I mean, everything's up a lot. So there's less that I'm doing. I'm doing more on the event-driven stuff because stuff comes out of an event-driven situation, and it's often fundamentally mispriced. The question is, in which direction it's mispriced. But, when something changes at a business, it's going to be mispriced if you can realize what's happening. A spinoff is going to be mispriced on day one. No process like an underwriting that has an order book setting the opening price. It just kind of starts trading one day. A bankruptcy is very similar, except for the bankruptcy, there's usually not even like a roadshow. It just starts trading one day. And this leads to dramatic mispricing all over the place. I would say that's where the best opportunity is going to be. And, it's a little different than my thematic stuff. But
but event
it is what it is.
I think it's great. I've been too fearful for the last few years, but I'm a little bit uncomfortable with how the market's been so good for so long, and how far the Fed can take it, and when markets maybe going to say no, you can do more. I think event-driven is great because you still get a return, but you're protected from a little bit of.
Right, but I think that you watch the news every day, and about once every 3 to 6 months, something happens in the news that makes you say, "Aha! This thing might be interesting now," and you kind of pile in. Event-driven, like I said, stuff's always happening. There's always corporate events. But there's a lot of stuff that I own right now, and it's doubled or tripled from where I bought it, and I think it's going to double and triple in the next few years. And the great thing about Project Zimbabwe, which is what I call unlimited fiscal and monetary stimulus, is that some of these businesses like St.Joe, we're in the first inning still of what I think is going to happen. And I mean, the stock's more than doubled from my cost basis, but I was buying more at today's price. I'm taking my winnings from event-driven, and I'm just putting more of it into St.Joe because, here we are, and we're in an everything bubble, and here's land which should be very well protected from inflation. It's trading at a third of the liquidation value. It's just wrong.
And I love your Zimbabwe framework because it's it's very. It illustrates sort of some of the things that are going on, and why you don't want to step in front of the freight train, which I probably did too much. But it also brings this question, at some point the people are not going to like the dollar anymore, right? I mean, it's probably not close to that point, but do you fear because that should stop the Fed and this kind of policy, right? Or
what are they going to buy?
If they don't buy dollars.
Yeah, what other currency would you want to own?
I think more euro, more yuan.
Look at the euro. It has a negative yield. It literally costs you money to own the thing. What is it, 20 countries that all hate each other? It's not meant for stability.
Maybe other stock markets, maybe
in
Japan.
I see the dollar as a thing you have in your account until you find something better to do with your money. And you're going to have dollars for a few months, and you'll find something good to do with your money. And if you're going to have dollars, or you're going to have rubles, or you're going to have euros, I don't know. There's zero frictional cost to exchange one for the other. And it's just kind of, something to hold while you wait for the thing you want to own. So I don't really think about the dollar going down, or what's it going to go up down against.
It's just that I think that's the only thing that can kind of force the Fed to change its
that won't force the Fed. Okay. The thing that will force the Fed is when middle-class guys can't fill up their car anymore, because oil is too expensive. When it's painfully expensive to fill up your car, they're going to print and stimulate until something breaks, and it's not going to be food. Probably in America, we'll probably create food riots in third world countries, but America, I mean, the average guy can afford food. It's going to be when all disposable income goes to the Middle East because they create an energy crisis, and that's what they'll probably respond like governments always do by giving you like an energy stimmy, and here's 10 free gallons, and they print the money and they hand them to you. But you'll eventually have, because the physical settled product is supposed to cash settled, that's the thing that'll break. And so, if you know that they're going to stimulate until they basically break that thing, then you want to be along the thing that's going to break them. They're going to intervene in the gold market, the silver market, they'll intervene in, currency and rates and S&Ps and junk bonds. All these are cash markets. They can just intervene. And in the physicals market, they can't intervene and put oil in my car. And I think they're going to stimulate to the point where global demand, instead of growing 1 or 2, is growing 3 or maybe even 4. And they're going to make it impossible to produce. And it's supply demand. They'll solve it eventually. And you'll have energy as an imputed cost in almost everything in life. It'll eventually create lots of inflation. And I think the dollar will roughly be range bound. It's what, 80 by 100? The DXY will be just roughly range bound. And because everyone's gonna have the same problems because everyone's following the same policy.
That's true. It's definitely not unique to the United States. That's true. Kuppy, I want to let you go and enjoy your day. But before you do, could you please tell people where they can find you, follow you? I think you're on Twitter. And please also tell them where they can find KEDM and try it out.
I think you just told them about kedm.com. We have a 4-week free trial. I think once you've tried it out, you'll realize that you really can't invest without it. We don't make stock recommendations. We don't give you a trade of the month or anything like that. All we do is give you the data and let you go hunting for the opportunities. Everyone interprets data differently, and my sincere hope is that 2 people will look at the same data point and have different time frames. One guy will go short, one guy will go long, and they'll both be super happy that we flagged that event for them. I have a blog, Adventures in Capitalism. I haven't written there in a couple of weeks. I need to get going on that, but KEDM launched.
I've been reading it for years. I think it's a great blog. It's very funny.
Thanks. Yeah, no, thanks. I appreciate it. And it's free. It's always going to stay free. And
you put great ideas on there as well. I think historically you put out some ideas there, the things that you find on your screens and. Right.
Yeah, I mean, we appreciate that. We've had a lot of multi-baggers that have flagged through there, but also, contrarian of view on current events. And then, on Twitter at hkuppy, but mostly I just shit post. I don't post too much that's all that interesting there. It's more, look, finance is a really dumb industry with a lot of very, very smart people doing dumb things. And I think it's really fun just to call out stupidity and hubris and retardation. I mean, in the end, you have a
maybe
bunch
to
of,
remind yourself not to fall.
I mean, not to take yourself too seriously. You have a bunch of people all suited up, wearing ties, pretending they're all smart, and really they're just the fools in the room. But they have all the money because they're managing money for their clients, and they're the ones moving the market. And oftentimes you listen to the stuff they say and realize they have no idea what they're talking about. And that's when you get to make money. And so I just like making fun of stupidity out there. None of this is investment advice.
I think it's really enjoyable, and I really like the whole benefit thing. I've learned so much from a lot of people, and I don't know sometimes how to give back, but I try. And thank you so much for coming on. I think people are going to love it. And please enjoy your day.
Hey, thanks a lot. Appreciate you having me on.
No, it's entirely my pleasure. Bye.